Hello. Hello. So today I came up again with a new video and it is on monetary policy including its tool and impact. So today I am going to discuss about the monetary policy. What are the details? So we know monetary policy consists of two measures, qualitative measure and quantitative measure. Quantitative measure and qualitative measure, as I stated, it consists of bank rate changing, the open market operation like selling or buying of bonds. It consists of the interest rate changing, the liquidity adjustment facility, the statutory liquidity ratio. Now interest rate changing, open market operation, reserve requirement or cash reserve ratio. What is the interest rate? The interest rate, specifically the central bank policy rate like the federal funds rate in the US or in the bank rate, which influences the borrowing cost throughout the economy. Now the quantitative impact and the qualitative impact, I have tried to give it accordingly. The change in the interest rate, it will directly affect the cost of borrowing for consumer and the business, and the higher, if the higher the interest rate, so it will discourage the borrowing and spending, because lower rate will stimulate it or vice versa. And if we see the qualitative aspect, because we know that in economics there are two things, in research also, qualitative and quantitative. Interest rate changes also affect investor sentiment and asset prices. For example, like the decrease in interest rate will lead to an increase in stock price, like the Federal Reserve decides to raise the federal fund rate from 2% to 2.5%. So what will happen? The commercial bank will increase their prime lending rate from 5% to 5.2%, and this makes the borrowing more expensive. Like as I stated, higher interest rate discourage the borrowing and spending. It's happening here also. So we have to understand the context. Now we come to the open market operation, next step, like buying and selling of the government security. It depends on the controlling of inflation. Like inflation is there and one wants to control the inflation, so one will act accordingly. And when the central bank buys security, it injects money into the banking system and increasing the money supply and lowering short term interest rate. If we sell security, it will reduce the money supply and raise the interest rate. And open market operation, it also influences liquidity in the banking system, which affect the long term interest rate. Finally, we come to the reserve requirement. Like if I want to increase the inflation, what RBI will do? It is a decision of the RBI, like it wants to increase the inflation. So in that case, it will, the situation is inflation. What is inflation? The rise in price level. The same thing, one needs to now pay more. So what one will do? One will increase the amount of, the inflation rate is more. So what people will do? They needs to take the money because money is outside. So they will sell the securities. Once they sell the securities, money will be coming inside and it will fall. So increasing the reserve requirement, it will reduce the amount of money bank can lend, which will contract the money supply, which I exactly tell, and that will eventually reduce the inflation in the economy. And finally, it will be a stable condition. So monetary policy, through its various tools and operation, influences economic activity by controlling the money supply and interest rate. And by understanding how these tools work and their impact, central bank aim to achieve price stability, full employment and sustainable economic growth. This was all about the monetary policy today.